Welcome to Econoday Unplugged. Today is Tuesday, July 3rd. I am Ann Picker, Econoday's chief economist, and with me today are Mark Pender in the U.S. and Jeremy Hawkins in London. Jeremy, you have a full plate to discuss today.
I do. We have the World Cup, we have the T20 cricket, and of course there's Wimbledon. But sadly, I guess we're not really supposed to be here to talk about that. So, let's get on with what we are supposed to be talking about. Numbers first then. From the Eurozone, it's not the biggest period for economic data, but it was important last week. We had the update, the flash look at June inflation, and that was 2%, so up 1.9% last time round. But more importantly, the good old core rate, the narrowest measure in this case, that dipped to 1% from 1.1. In other words, it effectively means that underlying inflation in the Eurozone is still going nowhere. It's say 1.1% a year ago, 1% now, so really you can put a straight line through it. Indeed, it's been within a 0.8 to 1.2% range over the last 12 months. Now, a second quarter GDP, it's got to be said, not looking likely as if it's going to show much of a pickup from the first quarter. If people remember, that was a 0.4% quarter on quarter or 1.6% annualized rate. I guess we've got to say that it's not really clear at this stage if the economy is going to be strong enough to lift core inflation back to target, let alone actually keep it there. As we know now, the ECB is banging the drum about finishing its quantitative easing program at the end of this year, but at this stage, it's still a case of wait and see. Just in terms of the rest of the figures, I think the main sort of takeaway from the last week or so, the PMIs, these are just the final data. But what is becoming increasingly apparent are some of the comments to do with worries about possible trade wars. Now, for some countries, it's more important than others. But if we look at the likes of Germany, I mean, exports are about 45% of German GDP. Now, the DAX is down, almost 3% on the month. If we compare that, the Eurozone average as a whole, where exports are only 27%, the Euro Stoxx 50 is down 1.3%. So it is starting to perhaps hit now that trade worries are beginning to hit some of those economies which are more biased towards export growth. What else can I mention? I should mention the politics. Sadly, have to do that again. We had an EU leaders summit last week, and that really just fudged a compromise agreement on the thorny immigration problem, which is becoming a serious issue for a number of these countries now. It's important because, as folks might remember, German Chancellor Angela Merkel, she's been under the threat of a rebellion from her sister party, the CSU, in her coalition, which effectively threatened to pull out of the coalition altogether if she didn't tighten her immigration policies. Well, it looked like that might well happen until yesterday, when there was at least a loose agreement between Merkel and the CSU. But that really just means establishing what they call transit zones along Germany's southern border, which will allow for an accelerated deportation of refugees who are not entitled to seek asylum in Germany. But that only works where Germany has a bilateral agreement with a country to send them back. And as things currently stand, Italy, which is typically the first stop in the EU for most migrants arriving in Germany, or indeed Austria, which lies on the main transit route, have agreed to join the club. So at this stage, this whole issue of immigration remains a very thorny problem. And it's not just important for Germany, but increasingly you get this talk about it being a threat to deeper European integration. And indeed, some have even gone so far as to say it could even cause the breakup of the EU altogether. So in any event, it's going to present downside risks to the euro as we go forward, and it's something to keep an eye on. UK, not too many numbers, but it's, I suppose, the focus for most of this week is going to be Friday, when we'll get a key crunch cabinet meeting on good old Brexit. Effectively, we got to the stage now whereby they're simply running out of time to come out with a proposal that they can present to the EU as to exactly what they're looking for when it comes to how they're going to deal with the customs issue once Brexit has taken place. As we stand there saying that they've got this new compromise agreement between the two sides, which they'll be taking to Brussels, but we don't know any details of this yet. And if it can't be thrashed out and agreed upon at this cabinet meeting on Friday, as we've said in the past, but it's still perfectly true, we could actually see Mrs May standing down, or indeed at some point a potential risk of an early general election. With regards to the economic data in the UK, I just want to quickly look ahead to next week with regard to Tuesday, July the 10th, as that's going to see the first release of a brand new monthly UK GDP series. This will be for May, but it'll be released every month going forwards. So this will be an early look at how the economy is performing. It's being released with a view to trying to give policymakers a better handle on how the economy is performing now, as opposed to how it's performing 3 or so months ago. So this is going to be a new indicator for investors to look at. Say kickoff is for the May estimate, and that'll be out next Tuesday, July the 10th. That's it for me.
Thank you, Jeremy. Mark, manufacturing is still thriving.
I guess, yeah. It's a difficult. The factory data, manufacturing data right now is out of the U.S. is showing definitely some unevenness, and I think it's was really evident in today's Tuesday, a report from Market Economics, the PMIs, the same outfit that Jeremy was referring to, or data that Jeremy was referring to. They have a flash. They divide their small sample survey into 2-week reports, which, for instance, the ISM, which is the stalwart version of that here, only does it at month end. Well, at halfway through at their flash for June, market was warning of a clear slowing in momentum. And at that time, the Philly Fed report here, which is a report that comes out at mid-month for the current month reporting on June, had a very similar result. But yet, when the final came out, the final sample for market, they reversed that. It was no longer a question of losing momentum. They had plenty of strength to report. And then the ISM that came out yesterday for manufacturing was incredibly strong and showed unusual capacity stress, which we've been seeing in these reports for the last year. What that means is delivery delays. In the ISM report, they were very, very extreme. Some of the worst that you have to go back to the mid-'70s and the oil crisis to find this level of delivery issues. And this is tied to overcapacity, and the weak link in here, or the bottleneck, appears to be the trucking industry and the lack of truckers. This is common, that trucking is one of the first places where you find scarcities. And these reports are also showing not only rising input costs, but some of the strongest traction in selling prices. And what that means is that there's being successful pass-through. The Federal Reserve has been pointing out about this in the Beige Book all year. They've been reporting rising prices. Now, that has yet really to come to the consumer level, which means that the middlemen, the distributors, are taking the hit right now. And I guess that's very typical for consumer prices to have a very stable relationship, or a very stable outcome, where in the economy itself down the pipeline there's stresses. So those were interesting signs of trouble. And they probably have already, they seem to have been not false indications. When you get a mix of data, like I think we're getting a little bit now, it's hard really to focus on one and to generalize from that single one. But if you look at them all as a group, you can see that there might be a little bit of trouble. And what little trouble there may be are very likely tied or in part to tariffs. Now, and as Jeremy was mentioning in the market reports, the PMI reports, there's lots of commentary in these reports of purchasers having trouble in their business. Lots of disruptions in pricing, lots of delivery issues, and it's a bit of a scramble. And the more the tariffs talk becomes, it builds, the more issues these have. If you look now at the factory orders, we had factory orders today, pretty moderate, I think, overall, a 0.4% rise. And that probably pretty much reflects the core of the report itself, which is mid-single-digit year-on-year growth, which is a respectable rate of growth, and is probably a welcome rate of growth considering the signs of stress that we're seeing. We probably would want a little bit of a slower growth. But if you look in there, you look in the details in there, you'll see a big unfilled orders now for primary metals. We had spikes in orders for aluminum and steel when those initial tariffs were put in place in March. We're seeing a little bit of a cooling in those order spikes, but these are being moved into inventories and especially into unfilled orders, which is an interesting dislocation. And the more of these tariffs that we get, the more of these kinds of dislocations we'll have, whether or not they meaningfully or significantly slow down the factory sector still has yet to be seen, what those effects are. So I think it's playing out. I just wanted to point out real fast here that one of the benefits or one of the big pluses in today's factory orders was a fourth straight very large build in unfilled orders. We were talking about that for primary metals. That's a small part of it. But this build in unfilled orders is really one of the best in years, and that is going to point to strength for employment. On Friday's factory payrolls, so Friday the employment report will be out. And there are shortages here, real quickly. The shortages here are not only the truck drivers, but in the construction industry, their rate of growth is being slowed down by an absence of or inability to find these construction workers. Yet employment is growing, and we're still finding a growth in these readings. And the unfilled orders for manufacturing points really very strongly to a strong demand for factory workers.
Mark, just ask you a quick one about, you're talking about, obviously we've got the potential inflation implications of tariffs. We got oil prices, which are, say 50% or so up from a year ago. I mean, why isn't that starting to feed through perhaps into the bond markets trading, since not so long ago we had this magic 3% number being taken out in the 10-year. No one seems to be talking about that anymore.
No, I think it's a global demand for safety, and the U.S. 10-year Treasury, for instance, is a central depository of that, a central measure of that. With all this uncertainty and volatility in the stock market, and then you have these economic issues and unknown movement toward a trade war that no one has ever seen. If you see, some report, well, what is a trade war? And they're going to try to tell you what a trade war is. It's not part of our memory. It's not. We don't know what this is going to be like, and that kind of uncertainty will build up demand for secure investments. What's interesting is that gold isn't moving here. And even as the long bond or the bond rate, comes down a little bit, gold is sensitive to the Treasury market. The higher interest rates are, the less demand there is for gold. But interest rates really aren't that high. Jeremy, do you have any hunches on why gold isn't going anywhere right now?
No, I've got to be honest, I don't. I think sometimes gold is seen as being a good inflation hedge, but it shows, I suppose, at the end of the day, people still don't really believe that inflation's out of control or it's going to go that much higher. It seems, if anything, although clearly your side of the pond is doing pretty well, as far as Europe's concerned, there's still a genuine concern about growth, and that's just been exacerbated, as you were saying, by talk about a trade war. And I think it's to do with the fact that at the end of the day, people. They would buy gold if they're more concerned about what was going to happen to consumer prices in general, and that just doesn't appear to be there yet.
Yeah, the inflation hasn't reached that point.
Thank you, guys. Until next week.